the only central bank short gold, which is, yep, that's the Fed, forced to revalue gold, which a consensus of first-tier liquidity providers suggests at latest after we enter the physically driven 2024 marketplace. As I say, not very far away. Now, the only gold and silver traders not seeing this gold revaluation play are the siloed COMEX speculators, acting as, of course, the useful fools for the officially sanctioned cartel. Now, whereas anybody else looking at the global physical footprints outside of this casino bubble evidences every single other central bank, without exception, are converting their rapidly depreciating dollars into physical gold. And it's not that gold is going up, it's simply costing ever more freshly printed dollars to buy the same ounce of gold, that by the end of the fourth quarter, yes, just 35 trading days away from when this episode is published, so little physical gold will be left to underpin this rehypothecation scam, it'll lead to an inevitable central bank-driven gold price revaluation.
In this video, Andrew Maguire discusses why the Federal Reserve is anticipated to revalue gold in 2024, serving as a trigger for global banks to reassess their gold reserves amid concerns about the continuous printing of currency and a looming economic downturn. Despite gold prices soaring in various currencies, the dollar's gold price declined in November, a move deemed as an officially driven action. Maguire sheds light on the physical gold demand by central banks, globally excluding the Fed, and raises questions about the authenticity and valuation of the U.S. gold reserves. He also touches upon silver markets, emphasizing the impact of speculators' bearish options, bets, and the upcoming expiration of capped options, hinting at potential significant shifts in gold and silver prices in the near term. Like, subscribe, and turn on the notifications bell to get more videos, like and check our pinned comment for some massive sign-up bonuses, as Bybit is giving you $20 just for creating an account so you can start trading crypto today.
Kicked off following the Bank of International Settlements revaluing physical gold as a first-tier asset class on the 1st of January, which is when gold began competing against US treasuries. Now, providing central banks, sovereigns, commercial trading advisors, and investors an alternative, far superior, zero counterparty risk alternative, safe haven investment and hedging vehicle. Now, during the course of this year, this alternative safe haven pivot sparked the largest central bank sovereign physical gold demand in history, severely impacting available global supply. None of this is seen inside the casino. Market footprints evidences central banks hedging previously unfactored US Treasury tail risk by their actions is already weighing on Treasury demand. It's this lack of Treasury uptake that's actually been spiking the bond yields higher as central banks, alongside institutional investors who have a global view, seek real asset alternatives, which of course include cash, but also gold. And under the Fed's induced smoke and mirrors haze, every central bank, including the Bank of International Settlements, who 1 year ago, almost to the day in November 2022, bought back their entire gold derivative positions, concluded it on that day, taking advantage of the Fed's synthetic attempt to cap the dollar price of gold. Now, note, though, that despite the Fed's best efforts, exactly 1 year later, gold is carving out a higher stairstep, over $350 per ounce higher than the $1,618 point, the exact point the Bank of International Settlements covered the last of their bets against a rising gold price. Look, there's only one reason gold is carving out a higher stairstep to rally from in 2024. Every other global central bank, both Western and the entire global South, have been openly on record as well as surreptitiously off record buying physical gold. And this leads to just one conclusion. Global central banks are accruing physical gold, so they can revalue this gold at close to the market price. And when any one of these central banks commences this process, it will trigger every other central bank to synchronize. And as soon as this happens, the Fed will have basically one of two options. Either they admit they've sold title to the Treasury gold to multiple parties. Well, clearly that's not an option. Or they're going to have to move to revalue this 831 tons of rehypothecated positions in sync with global central banks so as to avert what would be a foreign exchange imbalance. Bear in mind that gold's a foreign exchange cross. So it would create an FX imbalance, which would trigger multiple repatriation requests from other central banks requiring their undervalued gold to be returned for jurisdictional revaluation purposes. Now, if the Fed does synchronize to also value foreign exchange gold against the dollar, it would be the only way they could maintain their rehypothecation illusion, thereby averting unwanted repatriation requests.
Maguire highlighted the key events that are coming as we approach the close of the current quarter in the gold market. Notably, the dollar-denominated gold price experienced an unexpected decline in early November, prompting scrutiny of the Federal Reserve's strategic considerations. Analysts posit that this unusual occurrence signifies the concluding move before the Federal Reserve is compelled to reevaluate the value of gold, a measure expected to be implemented upon entering the physically driven market landscape in 2024. Beyond the confines of conventional financial discourse, it becomes evident that global central banks, excluding the Federal Reserve, are actively converting their depreciating dollar holdings into tangible gold assets. This not only impacts the cost of gold in dollars, but also underscores the challenge faced by the Federal Reserve. Amidst these dynamics, questions regarding the authenticity and valuation of the reported 8,130 tons of gold reserves held by the Federal Reserve come to the forex, introducing complexities into the broader economic narrative. Now we'll show you more clips of Maguire, but first, subscribe, and turn on notifications to let us know that you like the video.
Over 600 tons of gold cleared in London every day. And of course, that's just netted out on the books of the clearing banks. Plus the thousands of tons of gold traded in the futures markets every day. This minuscule physical repatriation request was spun out by the Fed into a foot-dragging, unbelievable 7 years to repay. Now, to provide contrast, our liquidity providers are able to send 25 tons of silver or gold bullion on a single commercial flight. So if it was there, 300 tons could have been actually repatriated at the latest in 12 days or less. Now, look, ultimately, out of embarrassment, to tighten up the repatriation timelines, the Fed had to make up shortfalls in this 300 tons of original German bars by replacing some of these Bundesbank banks with 1930s confiscated smelt gold, which did not meet original purity standards. Another embarrassment. So in fairness, really, two things came out of this rehypothecation example. Some of the original German bars had clearly been sold. And to make up the difference, these bars of 22-carat Treasury smelt gold had to be substituted. Now, given at least some smelt bars were tapped into, it's very, very strange that the 8,130 tons of Treasury gold holdings never reflected any withdrawals back in 2013 when this gold was supplied. Now, secondly, the Fed's effort to stall returning the bars that were in the original Bundesbank form, it provides empirical evidence that those bars had been rehypothecated, catching the Fed needing time to buy back those multiple ownership claims to these bars. And look, there are no other explanations. And it's not gone unnoticed by the global South central banks capitalizing on this dilemma and stealthily waiting for a real undiluted physical gold price to emerge, hence all the buying. And what we're trying to draw attention to here is that the Fed, the only remaining global central bank forced to be short gold, is in trouble. And given the unprecedented, officially reported, and even larger unreported central bank physical gold demand, in aggregate, conservatively, estimated at well over 1,000 tons of physical demand during 2023. Now, the window to capitalize on this opportunity is closing fast, as most first-tier physical gold wholesale market liquidity providers estimate that by the end of the fourth quarter, yes, just 35 trading days away from when this episode is published, so little physical gold will be left to underpin this rehypothecation scam, it'll lead to an inevitable central bank-driven gold price revaluation.
Anticipated to surge by 8% and reach an unprecedented 632 million ounces in the current year, the silver market is primarily propelled by robust factors. Key contributors to this notable growth include increased investment in photovoltaics, advancements in power grid and 5G networks, expansion in consumer electronics, and a notable rise in vehicle production. Notwithstanding the substantial inflow of silver into industrial applications, a noteworthy aspect is the absence of substantial investor demand in the market. Analysts highlight a projected 21% decline in physical demand from the investment sector, reaching 263 million ounces, marking a three-year low, and emphasizing a critical gap in the market despite the overall positive trajectory. Do you agree with the dates Maguire marks as the turning point for central banks to reevaluate gold and silver prices? Post in the comment section down below your honest opinion for gold and silver prices in 2024, and send this video to someone who hates Bitcoin. Thank you for watching, and I see you next time.